Consumption, then let's shift focus to industrials. Credit Suisse has recently released a fresh report laying out their big theme, a preference for investments over consumption, on the basis that an improving relative PE should support industrial outperformance. MS Unnikrishnan, the MD of Thermax, now joins us on the telephone line with his thoughts. Mr. Unnikrishnan, good afternoon. Thanks very much for joining in. The last month when we spoke with you, you had indicated that you were still a little bit cautious with regards the orders coming in. But this report by Credit Suisse seems to suggest that this capex turnaround is just about around the corner. What are you noticing on the ground? Are orders picking up? And where are they coming from? What are the industries that you're seeing orders from?
So when I was cautious about it, I also mentioned the inquiry pipeline in the market for capacity building in the non-government oriented sector or non-infra oriented sector is very positive. And I was only suggesting that point of time that will the order conclusions get delayed on account of the pre-final elections, and the final election is going to be happening later. Now, the latest, if I've got to talk about the ground level realities, there is no retardation in the order conclusion rate in all the consumer-facing industry. Such as if I have to talk about the kind of orders which are being placed in the market for capacity building, comes from chemicals, not the base chemical huge ones, the secondary chemical industry. Textiles is reviving. I've seen a lot of inquiries happening from 2-3 locations. Tirupur is revived, and you are seeing northern sectors also improving. Paper and recycling of recycled paper industry is investing heavily in the country. That is at the back of e-commerce industry, because packaging with plastic withdrawal happening, paper is going to be very much in demand. Though all of us felt that with the internet coming in, printing will die. Well, packaging paper is reviving substantially. Despite the reduction in the auto sales in the last month or two, auto companies and auto ancillary companies are certainly going ahead with their expansion programs. Virtually everybody. And even the tier 1 suppliers like tire companies in India are investing, and nylon companies are investing. Even carbon black, which is the black carbon which gets into tire making, everybody is expanding. I'm seeing a lot more of inquiries coming from food processing, order finalization happening in dairy. So these are the kind of varied sectors. Irrespective of who rules in Delhi, fundamentally Indian consumption is increasing. So people are investing in that area. That's the reality on the ground level.
Okay. What percentage of your revenues, sir, come in from the corporate side, and what percentage of your revenues are based on the government orders?
Thankfully, Thermax per se is not so much dependent upon the government. Okay. Predominant part of our order intake is from the industries which I mentioned about, or a couple of more to be added. There are certainly tenders which do happen. Of the 6,500 crores of orders which I do carry forward right now, approximately 1,500 would be coming from the public sector, not the government. We don't do any work for the government directly. Public sector, which of course will have, like say, fertilizer industry. We have government fertilizer PSUs we have orders from. We have orders from maybe 1 or 2 of them which are indirectly government oriented through a DRDO or equivalent of that.
Is, not just for Thermax, but in the industry, is any sort of funding constraints that you're noticing?
For the kind of projects which I mentioned about, no, certainly no, because the ticket size of these projects are varying between a 500 to 1,000 crore. And most of these companies do have not so stretched balance sheets, so their ability to be generating equity and debt is not so much of a problem. So this kind of industry and kind of order size which I mentioned about will not find it difficult for generating money. However, for the steel industry, certainly we do find people are overstretched. Cement is another area which is investment happening, which I did not mention the earlier statement when I made. Virtually every cement company in India is going for waste heat recovery based captive power plants. There are so many inquiries in the market today, and thankfully most of the cement companies in India are very healthy and fairly under leveraged. So for them to generate both equity as well as debt is not so much of a difficulty. However, the power industry, whatever inquiries could even be existing, I don't think any bank is willing to be funding them at this point of time, both on account of the call count firing, and second in terms of their current balance sheet strength.
All right. Frank and candid as always, Mr. Unnikrishnan. What about big orders? Last time you spoke, you were still a bit cautious on large orders coming through. Are there any signs of it picking up?
Certainly no. in the very large size orders of maybe 500 crore, 1,000 crore kind of size orders are not in the offing in India at least. Outside also very rarely at this point of time. So most of the capital goods industries currently, barring the big projects of infra, which is road building or dam building, which I'm not counting on. I'm talking about equipment supplies and plant and machinery supplies will have to be comforting with maybe a 50 lakh to maybe a 5 crore order, 10 crore order, 20 crore order, 30, 40, 50. Okay. Triple-digit crores of orders will be a distant cry for some time to happen. But those who are well spread across the globe, those who are selling outside the country also, should be able to get those orders from outside India only. From India, I'm not expecting 500 crore kind of size of orders, at least for the next 1 year.
Okay. You spoke about the sectors which have seen a revival in capex. There's cement, there's textile, there's the food industry, as well as the auto companies are going ahead with their capex plans despite the slowdown. What percentage of your 6,500 crore order book comes in from these sectors where we have seen a revival, which can provide that extra delta to your earnings?
At least 50-55% of my orders do come from this sector solely domestically.
Okay.
Yeah.
So there should be an improvement in your earnings in the coming year because 50% of your order book has seen a pickup in terms of momentum.
Yeah, I'm hoping that current year already we are growing. So next year also we should see growth. What percentage growth is the only question. We are hoping that next year also we should grow by a double digit.
Decent going for the market, so let's focus on how the year has been. Here's a look back at the year through the lens of various sectors. So today we kick it off with the banking space. Abhishek Kothari is here to rewind the year for us. Abhishek.
Was a Swachh BFSI Abhiyan undertaken in 2018. So 2018 was a year of Swachhata and Parivartan in the banks and finance sector with focus on asset quality, management changes that we saw, NBFC valuations and consolidation. But after a very, vulnerable 2018, 2019 promises to be much better on account of the NCLT recovery and the growth that we are seeing. So how did the 2018 begin? It began with the Nirav Modi scam. RBI decided to crack whip on the asset quality and barred restructuring of loans, as a result of which the RBI's action, the banks reported the worst ever quarterly performance with a loss of over 55,000 crore in the Jan to March quarter, with gross NPAs in absolute value rising to over rupees 10 lakh crore. That was up almost 16% on a sequential basis. So the big cleanup was over, and in the month of September we saw the losses falling sharply. So they reduced to about 3,731 crore of what we saw in the Jan to March of 55,000 crores. So, but the other big theme that we saw was the change in various managements that we saw. It began with Axis Bank. We saw Shikhar Sharma's tenure, which was cut down from June 2021 to about December 2018, and the bank immediately got Amitabh Chaudhary being inducted. ICICI Bank, on the other hand, also saw Chanda Kochar stepping down early amidst controversies over some loans given to the Videocon group, and Sandeep Bakshi actually taking charge over there. Rana Kapoor at Yes Bank is also set to step down at the end of Jan 2019 to make way for a new MD and CEO. But perhaps the biggest change that we saw in the roles were at the central bank, with Urjit Patel resigning following a standoff with the government on several issues, and veteran bureaucrat Shakti Kanta Das taking charge as the RBI governor. 2018 was also the year where NBFC saw the Swachhata in their valuations. So the spotlight actually began with the risky practices that they undertook, which got exposed after IL&FS defaulted on the repayments. This caused a credit scare and saw liquidity actually drying up and bond yields actually rising. So shares of NBFC saw a sharp correction by 30 to 50%, which led to massive correction in the valuations of NBFC. But one NBFC got closer to a dream deal was Capital First, which is set to turn into a bank after integrating with IDFC Bank. Consolidation, on the other hand, will also move ahead next year when we see state-owned banks like Bank of Baroda merging with Dena Bank, merging Dena Bank and Vijaya Bank with itself early next year, that is by March 2019. Looking ahead, 2019 seems to be a very good year for banking sector. Credit growth has picked up to 15%. Now, if you compare this 15% on a base, it looks like a base effect of 15%, but the absolute amount, YTD growth has been as good as the whole of fiscal 2018. So the picture for banks with better capitalization looks really good, while the picture will not be the same for NBFCs, especially in the housing finance sector and vehicle finance sector. However, in the NBFC sector, we'll see growth amongst gold financing and consumer finance NBFCs. Back to you.
Okay, Abhishek, thank you very much for that. As we wrap on this show, we leave you with a word from Unnikrishnan Mishra of Credit Suisse. He expects to see a meaningful and sustainable capex recovery going ahead.
The government has been responsible for the pickup in capex. Actually, the government sector has been investing at the same pace for most of the last 7-8 years. So the GFCF to GDP from the government side, the public sector side, has actually been flat. So the pickup that we are seeing is not really government. Steel capex has started. Our view remains that power capex also in 2-3 years will start off. So I think that this is setting the ground for a very meaningful and sustainable recovery investment activity. Private corporate capex has been growing in the mid-teens, actually 14% CAGR. Of course, the machinery capex was up only about 10%. 10% is still much larger than what we had expected we would see. In intellectual property investments have been growing at 22% a year. So there is still quite a bit of investment actually happening. Relative underperformance of the private corporate banks compared to the private retail banks, it's been staggering. To grow GDP at 7%, you need energy supply to grow at 4.5% because your efficiency gains cannot be more than 2.5% a year. Anyway, they're one of the best in the world. This is a note we had written in October. Almost all dense forms of energy are imported. Oil, gas, metallurgical coal. The only thing you have is thermal coal and renewables. And renewables are not large enough. I mean, people think that it'll solve our problem. I hope and pray it does. But on current economics, it doesn't seem to be in a position to meet our energy needs. So, however unlikely or however environmentally unfriendly it may be, if you have to provide energy to people, you have to mine more coal and you have to produce more thermal power.